Man,
Wow.
that was me playing
That
guitar.
we were both doing all
Jim
that
on
music.
drums and Emil off to the side.
I was doing I had a little maraca.
Before we get started, I want to just off the top make a prediction.
Oh.
Tomorrow we're going to rally back to all-time highs.
That's your prediction?
That's my prediction. Oh, Jim, I'm getting my cheeks slapped right now. To quote the ancient Chinese proverb.
That was Confucius?
That was Confucius. Yeah. I'm short some quantum names and the big nuclear name Oklo, and I'm just it's not a good time. It's eating into my profits for the year, which is very, very frustrating, but I'm fine. It's just goddamn. We'll get into it.
Well, welcome back, everybody.
Welcome back
to a Tuesday weekend rip, a very special jam session,
a weekday rip,
if you will.
Mm-hmm.
Another classic jam session coming to you.
Yeah.
This one's going to be the Bubblehemian Rhapsody.
Yeah, because
you couldn't tell by that incredible musical intro.
Oh yeah, and the thumbnail, all the capex, all the AI capex is going. We're easily 5% of it. With what we churn out each week with the thumbnails and with
although maybe a little
AI
lower
music.
because this time they didn't have us dancing, but so
yeah.
I mean, how could we not get the Bohemian Rhapsody in there though? I felt like we should have been singing the version of the Bohemian Rhapsody. I mean,
they'll figure it out. Jim, it's good to have you back. It's good to see you. I understand that you were just in Munich.
Yes. At Voltoberfest, actually, we went out to Munich, not for Oktoberfest, stayed for the Oktoberfest, but went for the SIBO's Risk Management Conference. Equally as fun and exciting.
Does that get even rowdier?
Oh yeah. Voltoberfest, yeah, so exciting. Sexy is what RMC Risk Management Conference. That screams sex appeal. How about what you guys?
Oh my god! Do they have a wet T-shirt contest?
All the ball managers, yeah,
all the guys going up there,
right.
That actually would be pretty fun. I mean,
a wet T-shirt, with just those guys.
If I were in charge of that, I'd have fun with it, man.
Yeah.
Screw it. What else is going on? You talk about risk. What do they talk about at those things?
Managing risk. What everybody loves talking about, right? How do we manage risk?
Wow.
But truth, SIBO, the Chicago Board of Options Exchange, biggest options exchange in the world, has seen dramatic growth in options volumes for the last 3 years. All structured products, anything options related is a buy and has been a buy, not just in terms of the stocks, but the issuers, the structured products, the brokerages that deploy the options and bring in the volume. It is a secular theme that very few people talk about. Miners and crypto and all those things that are going on. But one thing that not many people talk about is the dramatic exponential growth in options and structured products and everything tied to it, and the bull market that is driving so many of these other names. So that might be a theme we could talk about. Actually, that's kind of
I was going to say it's like the antithesis of risk management. I've been seeing so many of these 2x bull ETFs on individual names, and it's crazy making. Like for some, like this absolute dog shit Rigetti Computing has like a $10 billion market cap on quantum technology that is years away from even seeing any kind of revenues. And they've got their own 2x Defiance daily target, 2x long RGTI ETF, and it's at $166. I don't even think there's one on StockTwits for it, actually.
Well, one of the beautiful things about risk management, people don't realize, it's like gas and brakes. This is a great metaphor that some people use in the risk management space. I think it's actually really cool. It's, if you're in a race car, right? Everybody loves the race car. Everybody wants to watch the thing go as fast as possible. Full, it's like number go up. It's the same thing. It's just want like convexity to the upside. That's what people get excited about. But what wins races in an F1 car race? It's gas and brakes. If you just go all gas, you're completely off the, you're out of the game. And so the brakes can make you go faster, ironically. And people don't really understand that. I think the idea in risk management is is not just let's be less risky, which is what people think. It's let's manage risk so we can take better, bigger risks. And I think that idea is lost on a lot of people. Breaks are important to make more money, to go faster. And I actually, there's a lot of people who argue like if you can just manage risk better, then you can use a lot more leverage and get more convexity to the upside as well. And so we can talk about that a little bit too today. But I think that's one of the things that most people don't understand. And that, again, one of the reasons options go full circle here and the volumes are going to the roof is whether people fully understand all of the details of risk management. I think people are picking up on the fact that you can use optionality and leverage to take more upside leverage while actually having less total risk, right? And that idea is super powerful, and I think that's one of the things driving optionality and volume. By the way, tied to kind of the secular rally in counterintuitive, but tied to the secular rally in commodities and precious metals, tied to the secular move in crypto, in my opinion. I think I've talked about this before, but $500 trillion of long assets, stocks, bonds, more traditional assets. But people are increasingly realizing because we're in a bubble and valuations are high and like, wow, all these crazy things are happening, bifurcation, global conflict. But people are realizing that, well, how do I diversify? How do I take this risk and continue to stay in the game, make more money?
Right.
But somehow manage the potential risk of it all falling apart. I don't want to lose
without just buying straight up puts or calls on the UVixie.
Correct. And everybody's like, I don't want to buy puts, or if I do, how do I manage this, that, the other? And the reality is people are trying to diversify. People are trying to manage some type of risk, even though they don't think about it. That's risk. I got to manage risk. How do I maintain my gains and not give up the losses, or put myself in a position where I'm going to blow up my account or whatever, right? And what that amounts to is people are trying to go do other things like buy precious metals. That's why gold miners have had this crazy run, and commodities have had a crazy run. Go do crypto because it's a diversifier in terms of currency risk and all other kinds of things, but it still has upside. Optionality and the move towards optionality, similar thing. How do I keep making bets, taking risks, but doing it in a way and with leverage, with maybe an asymmetric trade opportunity, and structured products, which are part of that, are growing as well. So these are all attempts to be more non-correlated to just a stock bonds kind of thing. And 500 trillion stocks, bonds, private equity, private credit, real estate, traditional fuddy-duddy. Now 15 trillion of these other things I just talked about, up from 5 just 3 years ago. So 15 though is still tiny.
Oh yeah, dropping the bucket.
And that's why those things are moving the way they are, and the volumes into them are moving like crazy, and that's driving price and convexity and commodity precious metals and in crypto. But it's also driving massive volumes into hedge funds and structured products and options trades, which are having major effects on market structure. So all those things are related, and you can actually bet on that. Bet if you want to bet on an asset as well by betting on SIBO stock, CME stock, asset managers who do deal in this space with hedge funds or whatever, whether it's Brookfield or Man Group. You can do a combination where you're looking at crypto and like Coinbase with, things. There are ways to play that theme, which are equally as important, in my opinion, in the coming decade as some of the precious metals and crypto stuff as well.
Yeah. So that's probably a good jumping off point with gold and crypto's kind of taken a bit of a hit recently, but it seems like I think we're going on 5 months straight up, 5 or 6. I've lost count.
Yeah, I don't know if you guys were. I think maybe you were, Ben, but like listening to me 4 or 5 years ago.
Yeah,
and when gold was in this kind of swoon and oil was trading 120 or whatever, right? I think that was early 22, about 3 years ago. That was not even 4 or 5 years ago. We made a very, very aggressive call, like You want to own calls in gold, period, point blank. It is way too cheap on a directional basis, but on a convex, basis, all of the structural forces are forcing inflation, whatever, currency issues. And it's just absurdly cheap. And we made that call aggressively at that point. And the bet was not just that gold could have an incredible positive run, but that it would be incredibly volatile as well. And if you look back at the 60s and 70s, which had a lot of the same driving forces, most people know that gold was the best performing asset in the 60s and 70s. But what most people don't realize, it was also the most volatile asset in the 60s and 70s. And that was two directional. I mean, obviously more up than down, but you had some massive down moves as well. And so, the play in gold will continue to be long dated calls, long vol as well as long delta. But if you think it's just gonna be one direction, I also got news for you. That's going to be a wild ride, and you will get a pullback in gold at some point. That's going to just really hurt people and make people lose faith. And then, I don't think that's this year, by the way. I think it will come, probably sometime in a year or so. Mm-hmm. But when that does come, it's going to wash out a lot of people. But I want to be clear, this is a 10, 15 year bull market in precious metals that we're amidst. And it's not just precious metals. There's a lot of other things we can talk about there that are going to be complete outliers to more traditional investments.
Do you think that there's going to be any type of reckoning coming anytime soon for all of this AI? I'll just call it crap, because at this point I don't know what to do or say anymore. I mean, it feels like NVIDIA had, I could swear I'm living in Twilight Zone or something, or Groundhog Day. I could swear they just invested in OpenAI.
Right.
And we just got the headline that they are investing $100 billion in OpenAI to give OpenAI the capital that they need to buy the GPUs from NVIDIA themselves, or to buy the GPUs that OpenAI needs. And it's just, everybody's been posting the what's the snake eating its tail called?
I'm blanking.
Ah, geez.
But yes, it's basically just 10 different companies trading money back and forth between each other.
I mean, at what point is it? I guess we all know at this point that it's a bubble, and certain people are talking about how all the numbers are bullshit, and it's kind of got echoes of the .com bubble, in that there's a lot of just like letters of intent and a lot of circular kind of spending going on. And I obviously know fundamentally it's different than back then, because there are actual cash flows and revenues and stuff backing these moves up.
It's not that different.
Thank you.
I traded
I feel
and
less
worked.
crazy.
No, it's not crazy, but you also need to understand what a bubble is and how it works. So first of all, we are at valuations, not just from a price to earnings basis, or price to sales is way more expensive, price to books in line, like any traditional metric puts you at or higher, I would say, than 2000. The 2000, March 2000 top. Again, I think I mentioned this on here, like in 2021, 2001 and 2002, I apologize. After I went through that, I remember thinking to myself, man, I can't imagine everybody making that mistake. That was an obvious layup, crazy situation. I can't believe the whole market got there. Can't imagine us ever going there again, because markets have memory. Like, they wouldn't let that happen again. I remember thinking that, right? And here we are 23 years later at those valuations, but more importantly, I have to paint some context for people who weren't around in 2000. In 2000, we were in a budget surplus. The USSR had just collapsed, and we were the undisputed hegemon of the world. It wasn't even close, right? China was a shell of where it is now. It was, probably 20% the size, 10% the size. I could not express to you and interest rates and inflation were on the way down secularly, like because the Federal Reserve had absolute control, and Greenspan for the first time was lowering interest rates and lowering the natural state of unemployment. We were just embarking on this like little experiment. Man, that is not the case right now, right? We every single one of those, like national debt, whether you want to look at it on that metric, if you want to look at it on deglobalization and global conflict, if you want to look at it on, any number. I mean, any like risk, but like rational, like what's going on in the world and what risks exist. It's a different world. However, valuations are the same, and they're the same for the same reasons, which is this simple idea that this time is going to be different. That's you have to, for a bubble to form, you need this one thing, which is something that people could believe, that it's something powerful enough and important enough for people to be like, well, this is so important that this time is different. We had that with the internet. That's how people felt about the internet and how it was changing the world. And guess what? The internet changed the world. Didn't change the fact that we're in a bubble. Didn't change the fact that by 2002 the Nasdaq had dropped 91% and 97% of internet companies had gone bankrupt. Right, like it was still a bubble. Some companies ended up coming out of that and becoming some of the biggest, most powerful, important companies in the world. But guess what? 97% went bankrupt. Right. And there was a lot of volatility and losses. And there was, by the way, from March 2000 to 2012, you didn't make money. Like if you invested in March 2000, it took you 13, I think, years to break even again. This time is not different. The AI is incredibly important. It will change the world. It is changing the world. I am not, don't come at me being like, but it is like AI. It's like, yes. But who's going to make money on that? Are the valuations there that support that? How is this going? Who are the benefits of AI going to accrue to?
Well, do you think that? Do you think that aspect will be similar? The way you were describing the 2000 internet bubble, where 97% of people fall away, and you have these massive.
Yes, I think we have no idea who the benefits are going to accrue to of AI. Actually, I would argue there's a high probability that it does not accrue to those creating AI models. That's going to be commoditized. By the way, how many companies are making AI models now? There's like every week there's a new company with a new AI models that's the best AI model. I'm here to tell you that's going to intelligence is going to be a commodity. Now, what that intelligence allows other companies to do, I actually have a theory that there's 3 places in particular that are going to benefit dramatically more than any other places for MMAI. One, if you have a unique data set. Look, there's lots of smart people around, right? By the way, I'm not the smartest person I know. There are a lot of smart people out there, right? I may have a specific knowledge that's a unique data set from a unique set of experiences that allows me to talk about something that's very important. Doesn't make me the smartest person in the world. It's not intelligence. It's intelligence combined with some understanding and some knowledge that other people don't have. AI itself, I think, is going to accrue to unique data sets. If there are unique data sets out there, you want to be in those stocks because they are going to be able to take advantage of that and use that to their benefit. 1, 2, energy. It's going to take a tremendous amount of energy to do this. We are creating a super intelligence that everybody's going to want access to it. Every company in the world, and okay, but energy is a limited supply. Intelligence won't be. And guess what goes up? The thing that's in limited supply. And then lastly, I think the most important thing outside of creating things and intelligence and all these things is, as for human beings at least, is health. And it's the ultimate science, and it's so inefficient. So if there's one other place that's going to just dramatically benefit from AI. It's healthcare. In my opinion, there's other places, but those are the kind of areas. And by the way, that's not where the crazy valuation is, right? None of those things I mentioned to this point have crazy valuations. Energy is cheap, right? Generally, I mean, yes, there's some nuclear stuff going on, but energy broadly is cheap. Healthcare stocks are actually some of the cheapest out there, and there are plenty of places like United Healthcare. United Healthcare has some of the best data in the world in healthcare. Unique data sets, and you get healthcare, right? That's pretty interesting at record low kind of valuations based on what, So my point is there's a yes, we could get in more specific names and everything, but the big idea is the same. It is people are focusing on a bigger theme, and it's irrational, but it's not irrational. I hate that word irrational. It's actually, markets have never been a function of rationality. Fundamentals don't matter. I've talked about this before. There's tons of academic research that said fundamentals are a incredibly poor factor to use when betting on the direction of market outcomes at any period less than 10 years. However, you start approaching 10 years and longer term, 20 years, really long-term investing, and they're incredibly accurate. This is why Shiller came up with the CAPE, and why all these other people scale things to 10 years. Interest rates over 10 years, those are incredibly mean reverting, incredibly valuable. But if you're looking for that to somehow give you what's going to happen the next year or 2 or 3 or 4, you're thinking about it wrong. It's a matter of how many buyers are there versus how many sellers. It's not irrational. It's incredibly rational. It's actually way more rational than trying to use fundamentals. How many buyers there are versus sellers mean number go up if there's more buyers, and number go down if there are more sellers. And those factors are a function of liquidity. Anyway, so yeah, keep your eyes on, I always talk about this, back to risk management, the SIBO and the risk management conference. Valuations are a risk management tool. They are not a predictive tool for where something is going. Eventually, long enough, 10 years, 15 years, a liquidity issue will happen. The gas will sputter on the plane, as I've kind of given that plane analogy, right? And you'll be at 60,000 feet, and then all that matters is how far off the ground you are, right? And so that gap will narrow very suddenly in a time of a lack of liquidity. Right? But while the plane's flying, it has that mean reversion has really little to do. That fundamentals, where it should be in people's mind is not a likely. The mean reversion won't be a function of that. It'll be a function of the liquidity itself coming out, and eventually, guess what? Companies, much like 2000, again full circle. Things will come back into line because guess what? Those companies just don't have enough money to exist anymore. They need to generate their own liquidity when liquidity is gone. And if they can't generate their own liquidity, number go down to 0. And that's when it'll matter again. But that's a function of liquidity again, right? And that's how you need to think about these. But being in a bubble does not mean you should be short. Okay. Being in a bubble means certain things that are predictive, by the way, about supply and demand. And it does mean that there's more risk if and when liquidity dries up, which is an important thinking about risk and how you manage that. But it is not predictive in terms of direction in any short period of time, meaning even years.
And as we're going into an environment where interest rates are dropping, do you see that as just more air being enabled to be pumped into that bubble? Because that's what's got me worried is rates are dropping as we're at all-time highs with a lot of these speculative names absolutely ripping faces off. And I just wonder if that means, shoot, we're probably going to just keep going then. Because I don't see anything... I don't see any reason for any I just don't see any catalyst for this to stop anytime soon.
Yes.
Great.
This is the way things work. The reason things stay irrational longer than people can stay solvent, and again, I hate that irrational word, is because quite simply markets are reflexive. What happens when we're in a bubble? When valuations are high? What do institutions do? Institutions lighten up. People say, well, this is a bubble. I don't want to be this long. Let me take down my exposure. Right? Well, guess what? That means supply versus demand means, do you know where institutions were just 2 months ago in terms of allocation?
20?
0. Do you know where they are now?
5.
20.
Ah.
Are you surprised number go up?
No.
All right. What happens when we get the market keeps going up and that 20% now has to go to 40 or 50 or crap?
Just
we're at the
keeps
end of
going,
the year
man.
here. We better catch up. Like we're behind. Right. So that's just part of it. I mean, that's not the whole story. The whole story, number go up in general because there's structural reasons number go up. Number go up because Federal Reserve is pushing money in, as you highlighted. For the first time in history, the Treasury, which has, for political reasons, has incentive to keep the bubble, the plate spinning. It was already shortening duration dramatically in issuance, which is essentially QE. So Treasury now has taken over also Fed, and using both at a, hey, whatever it takes way to squeeze numbers higher. And it's not just that. They're trying to push long-term yields down, which itself drives more liquidity. So that's one. Two, we have the largest, I just talked about all the options open interest and all the people trying to do structured products and whatever. Guess what that does? That drives vol compression. And guess what? Vol compression does what? Makes skew, puts down, as the skew decays, that's von and charm flows as well. Okay. That's not going to do good things. As I mentioned, short interest is high and institutions are underweight. And then we have the interaction between long short equity hedge funds, which are growing as hedge fund assets are growing, as I mentioned. Now being with vol compression during times of lower liquidity like this summer, and guess what? November, December, when we get here to the end of the year, being in a position where they are so big that supply is pushing their longs down and their shorts up, and then forcing the underweight equities that they have to be bought back as well. So the whole thing is just like the machine is made to go higher. And if the incremental buyer, which is the Fed and the Treasury, is in the game and institutions are net short, it does not matter what valuations are until something causes liquidity to turn. Now, that's the complicated part, because knowing when that's going to happen, let me back up. The biggest source of liquidity in the world is not the Federal Reserve. It's not the Treasury. It's not the economy, which are probably the three biggest generators of liquidity in the world. It's actually markets. Markets are by far the biggest driver of liquidity. We got $500 million of long assets. I just said that before, right? How much QE is that to the world? How much new collateral is that when it goes up 10%? 50 trillion, right? So it's a loop. And at some point, if the Fed and the Treasury and all these other people cannot push in enough liquidity to keep number go up, right? Then number go down, and then number go down big. And so it's a circular reference, and that momentum game is so powerful. But eventually, it does unwind itself. It can't go on forever. And markets themselves are so big now, that despite record Federal Reserve intervention and the Treasury and historic, willingness to do whatever. Yes, in the short to medium term, they will push price, particularly at the end of the year here into early next year, given all the structural dynamics. And it's a midterm next year, so they will do everything they can to keep the plate spinning. But at some point, I'm guessing that's early 27, but it could happen sooner based on China invading Taiwan, or who knows what unforeseen thing can drive some liquidity event in markets. But my guess is that, or assassination, like you never know. There's so many things that can happen that are like seem unlikely, but there's enough that it's possible. But at some point, that number go down will cause itself enough illiquidity, liquidity to be drawn from the system that then we will rebalance.
So at this point, or you're kind of, excuse me, you're kind of thinking things have kind of changed. Obviously, we are now setting ourselves up for a squeeze into the end of the year and a Santa rally, and then probably, if I'm hearing you correctly, just same old story next year. Maybe a couple post-OPEX pullbacks that will probably just get bought up because it's a midterm year. And then maybe 27, early 27 is when you would expect the bigger correction to occur. Do I have that mostly right?
Yeah, so let me be more explicit. So, the thought last year, right after, decline, which we kind of called, the rally we kind of called back, was that this thing would stop because there was not enough liquidity. Again, liquidity is what matters. That's what we look at when we're making these predictions for going into the fall, right? For this thing to keep going, that the economy would slow, right? Which would drag on liquidity, that the Federal Reserve was not willing to get involved because of sticky inflation, which we thought would also be quite sticky. And that, that the Treasury alone was not enough to make number keep going up. Well, the administration did some pretty powerful things. They did historic kind of reissuance at the short end of the curve. They managed to push back the tariffs 90 days plus, right, to pull forward demand. Right? That doesn't just stop the effects of tariffs, but that pulls forward demand and pushes economic strength at the front end. And so all these things led to more liquidity, and then they, again, unofficially forced a resignation of one of the Fed chair people, and then, unofficially or more officially, quote unquote, fired another, and have essentially pressured the Fed to be much more activist. So the Fed is back in the fray. They've really strong-armed the Fed. The Treasury has done historic things in terms of issuance, and they've managed to keep the plate spinning with the economy with several things. And that took us through paired with, by the way, the institutions being underweight and the vol compression from structured products throughout the summer with low volume took us June, July, August. And as you get through that period without a decline, that's when a decline would have, a mean reversion that would have been more quote unquote rational without that liquidity, and given the supply and demand imbalances would have been a natural, mean reversion down to that spot until the Fed got more involved and pushed liquidity again early next year. That was the thought. Reality is they kept the plate spinning and they've kept liquidity pushing. And that's what matters for direction, and the calendar matters a lot, because now you have institutions at 20th percentile that are underweight. You have vol compression likely to come back at the end of the year, and volume weighted time accelerating again in the holidays. Hedge funds are having a tough year, and they're going to keep having to degross. And meanwhile, the Fed is just going to become more and more activist as they complete the full takeover. So yeah, don't try and short this thing into the end of the year and into January, really. That's pretty clear to me. Not to mention, Robinhood is, I just interviewed Vlad Tena. That's actually coming out tomorrow on our You Got Options pod. And the reality is, I was at that Hood Summit before I went out to Munich for the RMC, and the tools that they're giving retail now through social coordination, right? I mean, you thought Wall Street Bets was effective. Well, now what about the thing where you can just post your This is the trade I'm in as an influencer. And then everybody can click on a button and in real time join the trade.
Got it. I remember that was, God, there was a website in like 2009 that had the same thing, Co-Trader or something like that. Go on, I'm sorry.
But yeah, Robinhood has 20 million people on it. And never mind the coordination. Now you can trade options and futures much more actively. You can trade commodities, by the way, which, precious metals, commodities, we're talking about that trend. I think that benefits from this more and more as well. But yeah, the social piece, the ability to do options with analytics a lot more effectively. I mean, they can short now, like retail can short certain names as well. There's a dramatic amount of tools available now through futures trading. Oh, AI integration, they're integrating artificial intelligence. So like you can find weaknesses and attack those weaknesses in markets and push price. So there are tools to retail. Retail involvement is going to continue to be high. Institutions are caught short. Liquidity is at a record. Get out of the way. Now, next year, again, they're going to try and keep the plate spinning. The incentives are there. I'm sure we will get some type of a pullback if this runs into January. We'll get some pullback in Jan or Feb. Will that be 10%? Maybe. It's not like the number will just go straight. But the way this usually works in bubbles, and again, this is the way it worked in 98, 99, 2000, is as you move forward towards the end of the bubble, whether that's a 2-3 year process, a 1 year process, it's a megaphone. So the volatility increases into the top. And what naturally happens is the upside vol actually becomes so powerful in these squeezes at the end that implied volatility goes up because it's too volatile that you can't be short calls anymore. Everybody's got to be long calls. Retail's going to be pushing calls this time around too. Mm-hmm. I've been talking about this for about a month. And what are we starting to see? Market up, vol up, market up, vol up, market up, vol up. And this time around, most people are used to seeing that for 1 or 2 days and thinking that's a downside signal.
Oh, God, drives me nuts.
I'm telling you right now that in 99, that went on for a year, market up, vol up. And you want to make money without getting short on the market on the way up, and you want to make money on the way down too, buy long-dated calls, buy upside. Buy volatility. Volatility can work to the upside. These long-dated calls are too cheap. Given everything I just told you, can you believe that S&P 500, 4-month, 5-month, 6-month calls are less than 12% vol or 13% vol? I mean, that's way too low. So why would you own stock when I could buy that and get leverage and then have much less risk to the downside? And this is what I'm talking about with distribution. Everybody here just wants to be, are you long or are you short? What are you going? You know how you made money like in the best risk adjusted way, point blank, not even close in 98, 99 was not being long tech stocks. It was being long calls, right? On the NASDAQ, on the broad market, and watching those things just balloon every day. And guess what would happen when the market would go down? And by the way, we had 20% pullback in late 98. Like we had big pullbacks. You know what happened? The market would go down, the vol would go up too. So it's at this point in the cycle, being long stock as opposed to long-dated calls, especially coming out of the summer with all the vol compression. Again, you don't want to be short a 1 week or 2 week call. I mean, you can play those for gamma and direction, but that's a very different game. Start buying the long-dated calls because we're in a bubble. And in a bubble, price moves fast and volatile to the upside and eventually to the downside as well. And it's a megaphone. It starts getting wider with increased volatility upside. Part of the way bubbles undo themselves is not just the obvious, hey, just get so far off the ground. The valuations get so high that there's just so much more potential energy. True. But the other thing is as vol goes up and up and up to the upside, it's very hard to hedge. As volatility increases, the potential for an unpinning event eventually increases. So it's natural at the end of a bubble for vol to go up into a rally for some meaningful amount of time, for vol to become unpinned, realize vol to increase, and eventually that dynamic and that that situation leads to a broad unpinning of the market too.
So at this point, you're thinking probably after Jan, Feb, OPEX, opportunity for maybe 10% pullback, and then just continue on our merry way until post midterms.
I mean, again, everybody wants the 4 or 5, 1 year, 2 year prediction. Like, I'm telling you what the next 1, 2, 3, 4 months are.
Right.
And I think this is what gets people so caught too. I mean, we started talking about in June, like if this summer is placid and continues to grind higher, like be careful, because this, people see it as it's either up or down. But what it is this leptokurtic market, right? Where if the number is not going down, it's going to go up big. And so yes, the answer to your question is yes. As of right now, strong market into the end of the year. Could we get a pullback here in the next week? Yeah, there's a window of weakness, which you guys know, right? This is post SEP OPEX, which you'd expect that crazy run in the 2 weeks leading into SEP OPEX. That's the least surprising thing ever. And you have a period here where little mean reversion digestion makes sense, but is it going to be something big? No. Is it going to be a buyable event? Yes, if it even happens, which is coin flip. And by October going into OPEX again, you want to be bullish. And by by Halloween and early November, you better be full in. And again, playing that with calls, ideally not with stock, and long dated calls. Calendar call spreads are interesting, et cetera. But yes, you want to play those in Jan. And then depending on how far we go, how fast, and what vol is doing, we might get a pullback there.
Yeah.
That's whether we get a pullback there or we don't, TBD. And how big that is, 10% is a good, could it be 15 or, it could be real. Because if we run 15%, right, from here, a 15% pullback, with vol going up to the upside, which I could see happening, could lead to, again, vol up again in a bit of a widening of risk, which then allows for a more dynamic, move next year. And those dynamic moves next year and the increasing volatility, again, eventually undoes itself probably after midterms, because the powers that be have the levers to get what they want and are willing to do whatever it takes to get what they want. And they have the benefit of institutional shorts and retail army that has like a militia of people carrying AK-47s.
I find myself increasingly frustrated as a retail trader that it takes a certain amount of, I don't know if you would call it bravery or naivete, to just kind of close your eyes and buy the stories, because stories work now. And it seems like it doesn't matter. Oh, you got some new nuclear fancy technology that's just what the fuck ever. And quantum, like I said, quantum stuff. And I just don't have the balls. I don't have the, I just don't have it in me to buy and hold.
You're telling yourself the wrong story.
Yeah.
Then the story of markets is not a story of buying. And any time, again, shorter than 10 years, is not about buying a business. It's about buying a token, a thing, whatever it is. And are there going to be more buyers of it or sellers of it?
Right.
That can be a very intellectual game. It's actually the purest intellectual game. It is a thing that can be measured and predicted in supply and demand. The narrative that you're telling yourself that markets are a function of the valuation in any period shorter than 10 years is wrong. And if you think the numbers are going up because of valuations, that's also wrong.
No, true. I think it's also just when I've been doing this since 2009 personally. And when I was going through that phase of buying stories for stocks, retail was significantly less involved, at least like the younger people that are now, and there wasn't as much Reddit and Robinhood and coordination and easy access and stuff. And I'm just having a hard time increasingly adjusting to this new kind of market and paradigm where things do go up a lot longer than you would think, because of just how much volume and liquidity there is out there.
Now, the important thing that does dovetail into reality or valuation, so whatever you want to call it, like long-term value, is narrative, right? Because narrative is critical to getting buyers out, right? To causing demand. And so that's why AI works so well, because it's hard to dispute or hard to predict how it is huge. It's a big deal, but we have no idea how.
Can I ask a quick question about the difference between, so you're saying it's about the amount of buyers and sellers, but wouldn't you kind of say those two are linked just like you are now with this narrative? And so how is that different from?
It can be linked. Does not mean it is linked.
Right.
The point here is that if people, so I just gave an interesting argument, an idea, right, about United Healthcare just a little while ago. I just created a little narrative. It may be right. It may not be right, right? But that's my theory, and it's compelling. And guess what? I got a lot of followers. People might start to look into that and say, holy cow, there's something to this. And the next thing you know, people start buying and price goes up, which gives people more conviction. And then they start buying it. And then the next thing, it's a 50 PE stock. Now, it may be right. It may not be right.
Yeah,
I hear you.
The narrative and the idea and getting people excited and willing to commit money over an idea because is incredibly powerful. But you know what's the most powerful? When numbers go up. And then it becomes incredibly powerful. Everybody gets on board. And then the shorts get squeezed. And then guess what? It seems more right. There's so much more to the story. But the story, it always starts with a story. And so narrative matters. And the fundamentals of, or some argument, being able to make a cogent argument for why that may or may not be the right story is so critical to get people involved. But at some point it gets so separated from even that fact or reality. It's almost unconnected at some point. So yeah, valuations do matter. They're part of the story in terms of telling a narrative. That's why it matters. And being able to convince some people to get in and commit their money early. But once momentum starts and it's about other dynamics, it tends to disappear. It can be part of a bigger crowd. I think about crypto or Tesla, right? But way back when, the valuations were insane. What was driving price was call squeezes and all kinds of other dynamics and realities. But the story was powerful.
Oh yeah.
And so yeah. I'd say narrative is the most important, supply and demand dynamics and narrative to help kind of shape and push it. And at the seed of that tends to be at the very beginning, some type of evaluation or idea or something that may or may not be true. But by no means is valuation or fundamentals the primary driver of supply and demand.
You freaked us out months ago with your little birdie talking about like civil unrest and stuff like that, and government kind of takeovers and whatnot.
Doesn't seem so weird anymore, does it?
No, and it's genuinely, it's Marko Kolanovic was tweeting about it this weekend because obviously Stephen Miller had that very, very visceral speech at the Charlie Kirk Memorial. And
the fascist speech?
Oh yeah.
And I heard that. Where he seems like the Fuhrer for like 2 seconds.
Yeah.
And
you also linked that tweet from yours back in June about a crisis coming with Stephen Miller. I think it was an interview he was doing after post Charlie Kirk, talking about how they're going to be using the full force of the government to silence.
Never let a good crisis go to waste.
Man,
No,
oh
certainly
man, no
not.
kidding. And it's just what a stark contrast where depending on who you ask, it truly feels like society is on the verge of crumbling, especially when you're getting this kind of rhetoric from the people in power, and it just feels increasingly dire. But then if you look at the markets and you were just going purely based off of that, you would think that we're in
Well,
the greatest times ever.
At the same time, too, they're talking about how they want to pull back on reporting certain economic data.
Oh yeah, that too,
and all that.
Do you want to know what's good for markets in the short term?
Tell us.
Absolute government control.
Why is that?
Because at the end of the day, I said the short term, not the long term, to be clear.
Right.
Okay.
Because in the short term, that means they can control the price of what they want. They can take it over the Fed. Talk about a power grab.
Yeah.
But that's really powerful for stocks in the short term. Being able to get rid of all the bad news and just create good news, that's pretty powerful.
Mm-hmm. Being
able to decide, well, Intel, I don't want Intel to go down. I want Intel to go up. I'm going to go make an investment and push the price up. There are an unlimited, this is the US government, it's the biggest economy in the world. You know, like they have the power to pull infinite number of levers if they so see fit. Do you know what's harder for markets? When there are checks and balances and not one person can control things the way they want to control it. And in the short term, that creates more uncertainty and volatility, but that also allows the free market kind of to react to real things as opposed to just drive price. Now, in the long term, we all know, that's the short term, that the US valuations, which are dramatically higher than the rest of the world, that the free markets themselves and the trust in markets is essential to the long-term functioning of not just its success of markets, and quite frankly, the whole, the exorbitant privilege of the US dollar and all the other things that we enjoy. So rule of law coming apart and a lack of faith and trust in the institutions that have made America great, not again, but great, are in disrepair. It's from coming apart from both sides, by the way. Obama and Biden started a lot of this too. So this is not a political finger. It's kind of what, my fist at politicians but the reality is our system is in great decay, and that the long-term realities of that is we are going to eventually, once there are other alternatives, lose increasingly the faith of the world. And that is that's not a 1-2 year thing, but that is dangerous in the long term. So, but yeah, anyway, so yeah, those two things are, you would think that they would be related. It's not too different than the supply demand versus fundamentals argument, right? In the short term, things are a function of what, what's forcing buyers and sellers. And at the end, in the long term, it's about some level of rationality, sanity, and trust, and valuations and things that matter. But again, those things will eventually, over long periods of time, converge as a function of liquidity itself.
Oh boy, it's just so frustrating.
Yeah, but it takes. This is why I really try and pound the table on. You have to think in distributions and risk management, right? And how do you find the parts of that distribution that are undervalued? How do you figure out, and again, full circle to the SIBO conference, like that's what risk management is. And that's why those products are in a bull market. And that's why entities issuing them or involved in them are in a bull market. And that's not going to change tomorrow. If anything, the risk is increasing structurally and the need to diversify is increasing. And we are in the first or second inning of that. And it doesn't mean market, number go down tomorrow. That's not really what's important. There are opportunities to take advantage and to start managing for risk while also benefiting from the drive that people have that are going to need to get into that. And you can do that proactively. That's what vol does at the end. That's what a 98.99 bet on vol market up, vol up was. And that's how you made money in 98, 99, 2000, 2001, all the way up to the top and all the way down. And that's, I think, the way you really need to be thinking about this. Because if you're just going to play up, down, you're going to, good luck shorting this market. Good luck.
Yeah, I think also I got to remember to not compare and despair and not see and base my performance off of the performance of others. And because it's so easy. You see guys who are like, I'm up 5,000% on the year. Look, I just full port into all these meme names and shit. And I'm just like, okay, got to remember that's not a reflection on me. That is just good for that guy. I'm still doing okay. It's slow and steady.
You did pretty good on Fartcoin.
Yeah, I did okay on Fart. I did make money on Fartcoin.
Yeah, look, again, the key here is to stay in the game, play that game, try and do it with convexity in the right ways. And risk management, again, I think in the words of Warren Buffett, nobody knows who's swimming naked till the tide goes out. And, Warren Buffett has, fuddy-duddy, but he's beaten markets over the long run with dramatically less volatility, dramatically. And he's not a rocket scientist. So you don't need to compare yourself to the guy buying Fartcoin. You need to stay in the game, use those gas and brakes, to go faster. And you know what, the Fartcoin and whatever guys, they're going to go really fast, and then they're going to hit the side of the track and get carried off the field at some point. And if you're just watching that guy, he's going to go faster without the brakes for some point. But that's just not how the game is won. And those guys, probably most of them haven't learned that lesson yet. And there is the key is to learn that lesson and then not get scared because of it, but to understand the dynamics and still allow yourself to be aggressive and you learn how to drive the car in a more effective manner. And so, those guys they're playing a different game and they're driving without brakes, and that may look good for a while.
Looks so good.
It's
like, damn, are they drinking too? They're drinking and driving? God, why didn't I think of that? That looks so cool.
Stuff. They don't even seem to care.
Yeah, the risk management conferences aren't sexy. The wet t-shirt contests don't really happen at RMC that often.
Yeah.
So not sexy, but it does win races. And what's sexy is making a lot of money with less risk and staying on top of in the winner's circle with that kind of.
That's right.
All that stuff. So.
You can be proud. I think you did your risk management friends proud. You identified yourselves as the true race car drivers. You guys are the true F1 drivers.
Oh yeah. If I'm good at one thing, it's branding. We're the SIBO is gonna rename the RMC to like F1 racing from here
now.
On
Whenever I think of risk management guys, I'm thinking of just like hot European race car drivers. It's you've done a real service here.
Absolutely. Actually, to their credit, Jim, the RMC, the SIBO RMC in Munich did have. It wasn't RMC. It was. I apologize. Robinhood. I apologize. The Hood Summit actually did this exact thing. They had a race car metaphor running through the whole conference. And actually, when you went down to kind of for dinner at the end, they had it in this space where they had actual real F1 cars, and you got to like get in and change tires and do all this cool stuff. So Robinhood, they got that idea, Pat. They got the marketing down.
Yeah, Vlad's crushing it. I think that's probably a good place to wrap it up. Got to plug Stocktoberfest, which is going on in lovely San Diego, California, October 20th through the 22nd. So get your tickets. Jim, you're going to be there, no?
I'm going to be there. I'm going to be speaking about race cars. We might even have a wet t-shirt contest. I don't know.
Oh, yeah. Don't get me excited. Ooh, that's not a bad idea. That we really should.
You want people out to Coronado, California.
Yeah.
Yeah, that's a way to do it.
All right. Well, as always, it's a pleasure talking to you. I always learn so much, and I'm going to make some money. I'm going to be making money very, very safely. Thanks to you. And yeah, any parting words of wisdom?
No, honestly, you know, at this point of the game, you know, you don't want to fight this way, right? You're looking for opportunities, and markets also don't usually wait, given the dynamics. But yeah, parting words of wisdom is buy long dated calls.
Gotcha. Love that. You heard it, folks. Put all your money and mortgage your house on long dated calls.
That's not financial advice. Don't, you know,
not financial
I'm not
advice.
saying do it, but maybe, you know, think about it, do your own work, you know, consider whether that's a good investment idea for you.
Yeah. All right, Jim. Thanks so much.